Hello and welcome to this daily market commentary for Friday, January 17, 2020. The end of the week is upon us. Trade deals have been signed and President Trump's impeachment proceedings are gathering pace and the events in the Middle East have, at least for now, taken the back seat. All this as equities make record highs. FX has for the most part been quiet, with the major currencies chopping around in familiar ranges with maybe only yen crosses showing some real signs of life. So what would Friday bring? Well, dollar strength would be the simplest answer. Weak retail sales data in the UK certainly didn't help sterling's cause against the dollar. Couple that with the highest housing start number in the US for 13 years, and you have some late week momentum for the dollar. Euro dollar would suffer also as traders unwound long euro yen positions, as dollar yen itself was happy to trade in a tight range above 110. Equity markets around the world, around the globe, would be in the green, despite China's economy growing at its slowest pace for 29 years. Saying that, 6% growth for the world's second largest economy is still fairly impressive when you consider the US is probably looking to grow at nearer 2 to 2.5% on the year. US equities would open higher, but by the European close, they were virtually unchanged. Euro dollar had traded down as low as 110.87, sterling down to 130.10, Aussie 68.72, dollar CAD rallied up to 130.75. As I said, dollar strength would dominate Friday, but the day itself would die a death early ahead of the holiday weekend with little action during the US afternoon. Equities would hang on to some gains, with the Dow Jones closing up 50 points, despite a sharp drop in Boeing stock. The S&P and NASDAQ would also close in record positive territory. The one index that didn't was the Russell 2000, which I will touch on in my technical piece. As for the week ahead, there is little in the way of US data, although we do have interest rate decisions in Canada and Europe, as well as the annual Davos Forum in Switzerland. No doubt all eyes will be on President Trump's impeachment trial. So moving on to my technical peek, as I mentioned, I wanted to quickly look at the Russell 2000 index. The index tracks 2,000 small cap stocks and is often seen as a broad measure of the smaller, more domestically focused companies in the US. What I have here is a daily chart of the Russell, which is in green and red, and over the top of that, I've added the S&P 500 which is in orange on the chart. And obviously, there's a strong correlation between the two. But what you will notice in August of 2018, which is around here, the Russell was outperforming the S&P and made a high around 1740, as you can see from that line there on the chart. What we saw then was a pretty sharp correction, with the Russell dropping down to around 1260. Which represents a 27% correction between the end of August and the end of December. Now, obviously, at that time, there was a broader market correction. As you can see, the S&P has corrected also, but it's corrected only by about half the amount that the Russell 2000 did. Since then, as you can see, we have gradually retraced those corrections. And while the Dow Jones and the S&P, as you can see here, the S&P and NASDAQ have all gone on to make new all-time highs, the Russell has failed to do so and is still 40 points shy of that August 2018 high. As you can see here on Friday, we closed just very marginally below the 1700 area. So my point here is that equity market strength has been dominating the headlines for months, and many are calling for a pullback. If the Russell 2000 fails to make a new high, that could well be the catalyst for a broad market reversal, which in turn has implications for FX and commodities. So just keep an eye on the small cap market over the next couple of weeks for some warning signs of an impending change of sentiment. And with that, I hope everyone had a fantastic weekend and wish you all the very best of luck with the week ahead. Cheers.